Hopefully y'all can hear me pretty good. I'm in my office. I got my doing a little different thing today. But today, ladies and gentlemen, boys and girls, and children of all ages, we're going to talk about the Berkshire Annual Letter written by Warren Buffett himself. Came out yesterday on February 26th for everybody to read. So I spent the weekend or yesterday reading the letter, and today I'm going to give you kind of a feedback over the greatest investor of all time, what he has to say about his company. He didn't really speak too much on the economy, but there's some great nuggets and notes that are in here. But if you haven't done so already, ladies and gentlemen, y'all know what time it is. Go ahead and make sure.
Hit the subscribe button. Hit the bell icon. Hit that like, comment, and share button.
Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. But always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. If you are catching this live, please drop a comment and say hello as we go through everything. But without further ado, you know what's crazy? I did all of this stuff, but we're going to get straight into it. Y'all give me 1 second. I'm going to actually pull up the letter. We can kind of go through it together. I did all this stuff and kind of forgot to get into it myself. There we go. I'll take but a second. I guess we call it 2022. What's the best way to view this thing? All right. There we go. How do I pull this thing out the way? All right. Let me share this for y'all. I want to put myself here. And we're going to share this screen here. And there we go. All right. Here's his annual letter. Let's see what, he always opens up his annual letter. I read his letter every year, get some nuggets out of it, some perspective. It roots you every year to see, hey, what he's doing. He's been doing it ever since 1965. So ever since 1965 to way, 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 way before I was, many, many years before I was born, about 20 years before I was born, he's been putting these letters out. So right here, this is the Berkshire. He compares himself to the S&P 500 every year. And when he compounds it, when he puts in here, he says the compound gains. Move my thing out of the screen. I don't even know. I'll put it right here, my light. There we go. So the compound gains from 1965 to 2021, it's crazy. From 1964 to 20 overall gains, Berkshire has been up 3 million? Good gracious, 3.6 million %. In the S&P 500, 30,000% if you did overall gains throughout the year or whatever. So yeah, that's pretty crazy. But anyway, let's get into it. Let's see what he got to say. These are always some good gems. Let me run across this. Let me see what y'all got to say. Let's run this across. And we're going to go over his letter. Let's see what he got to say. Let's hear from the GOAT himself. You know what? Let me put my camera down. Y'all can't even see me. You know what? Let me get this out the way, too. Let me get this brand banner thing out the way. There we go. That's better, right? Yeah, there we go. See what y'all say in these comments. You know what? I don't even have my mixer on me today. So Alan says, let's go, Prince. He got Dukes on here, but I think he meant Dykes. But what's going on, Al? Thanks for holding me down, man. And Mark Vanderloot, he says, hello, how is it going? How's it going, Mark? How is it going, Mark? All right, let's go through this gem. To shareholders of Berkshire Incorporated, Charlie Munger, my longtime friend, have a job of managing a portion of your savings, which you're honored by your trust. So he said, our position, here's the two nuggets right here that I like what he said. Let's go. The two nuggets that I liked in the beginning. Where did I put it at? The two must-haves. Let's go right here that he said. I wrote these down. So I got a whole note list that I went through. So let's see how good I am putting this out. So he said, our positions carry with this responsibility to report to you what we would like to know if we were the absent owners and you were the managers. We enjoy communicating directly with you through our annual letter and through annual meeting as well. Our policy is to treat every shareholder equally. Therefore, we do not hold discussions with analysts nor institutions whenever possible. Also, we release important communications on Saturday morning in order to maximize the time for shareholders and the media to absorb news about markets open on Monday. A wealth of Berkshire facts and figures are set forth on the annual 10K that the company regularly files with the SEC, and we reproduce on pages K1 and K119. Some shareholders will find some of the details engrossing. Others will simply prefer to learn what Charlie and I believe is new at Berkshire. There are a little action. So they said they didn't do too much in 2021. We did, though, make some progress increasing the intrinsic value of your shares. That task has been our priority for 57 years, and we continue to do that. So like their little opening. So right here, what you own. They're talking to the shareholder, what do you own? So he says Berkshire owns a wide variety of businesses, some entirely, some in portion, right? Whenever our ownership or goal, here it is right here. Here are the two nuggets. He said, whatever from our ownership, our goal is to have a meaningful investment in businesses with both durable economical advantages and a first-class CEO. So right there, those are the two nuggets that he said. They're meaningful investments in businesses. They want a durable economical advantage and a first-class CEO. Now, when I saw those two things, it was kind of like, well, what is considered a first-class CEO? How do you judge a first-class CEO? So how they do that, I don't really know. I have one book up here that was kind of breaking down his annual letters. Let me see right here. Oh. Investing in between the lines. This is right here. So she kind of touched on it, but not really. So he says, hey, a durable economical advantage in the CEO, and he's going to point this out as I go a little bit further into his things. So he said, please note particularly that we own stocks based on our expectations about a long-term business performance and not because we view them as a vehicle for a timely market move. That point is crucial. Listen up. Charlie and I are stock pickers. Charlie and I are not stock pickers. We are business pickers. Very key here. So when he says Charlie and I are not stock pickers, we're business pickers. He's saying that, hey, some people pick a stock because of a name, because it's moving up, because it's the hot thing. Hey, this year oil is hot. Last year you had cryptocurrencies that was hot. So the year before that in 2020, you had technology that was hot. So you're kind of bouncing all around. You're picking different stocks, and they're saying, hey, don't be a stock picker. Pick an entire business. Very crucial. So right here, he goes on to say he made many mistakes. Consequently, our extensive collection of businesses includes some enterprises that have truly extraordinary economics. Many others enjoy good economical characters. Few that are marginal. One advantage of our common stock segment is that on occasion it becomes very easy to buy pieces of wonderful businesses at wonderful prices. That shooting fish in a barrel experience is very rare, and negotiated transactions and never occurs in mass. It is also far easy to exit from a mistake when it has been made in the marketable arena. So right here, he says it's easy to exit a mistake when it's made in a marketable arena. You can say this as a stock advisor or a person who buys stocks. Pretty much cut your losses easy and fast, right? So let me see what y'all seeing here. Okay. What's going on, Max B? Mark that. Max, you said, I want to reading this one's from back in the day. These ones from back in the day. Yeah. These go all the way back to 65. You know, you're talking about 20 years before I was born, everything that's going on in the economy. You know, these are kind of like the Bible for a lot of investors. You know, it's almost kind of like, because, you know, Buffett, he don't really show his face. You only see him once a year, if that, which if I was 91 years old, that wealthy, I would be nowhere near that wealthy, and I'd be 91. I wouldn't even be, I don't blame him. You know, keeps you out of trouble, keeps from saying something crazy. But Shows a lot of his character and personality, you always hear people saying, hey, we're a 70s babies, or 80s babies. He's a 30s baby. 30s. Great Depression time. So let's keep going here. Let's see what other gems we can get out of this annual letter that he's wrote. And I know he writes these by hand every year. That's why they're so notorious of people saying it. So I love to see what he has to say. So it says, surprise, surprise. Here are a few things about our company that often surprises even seasoned investors. Many people perceive Berkshire as a large, somewhat strange collection of financial assets, and throughout, Berkshire owns and operates more U.S.-based infrastructures classified on our balance sheets as property, plant, and equipment than we own and are operated by any other American corporation. Okay, that supremacy has never been our goal. It has somehow become a fact. Okay, so right here, they're saying they have the most U.S.-based infrastructure assets in their PPE sections on the balance sheets. At year end, this domestic infrastructure was carried by Berkshire balance sheet of $158 billion. I want y'all to guess, how much do you think Berkshire reported in cash? How much money do you think Berkshire reported in cash? I want y'all to put some comments below, just for fun. We're going to go over it. I definitely know the answer. It's going to be in here as well. How much you think they reported in cash, right? So here you go. Every year, our company makes substantial income tax payments. In 2021, for example, they paid $3.3 billion, while the U.S. Treasury reported a total corporate income tax receipt of $402 billion. Additionally, Berkshire pays substantial state and income taxes. I gave at the office is an unaccessible assertion when we made Berkshire shareholders. So they paid $3.3 billion in taxes, saying, hey, we pay our share of taxes. How much cash do you think Berkshire have? That's the question. Berkshire history vividly illustrates the visible, unrecognized financial partnerships. Let's get down here. A combination of resources. Now I think the next thing I want to get into, I'm going through this slowly. It was George Both River Falls in Nebraska. So he talks about buying the company. He's talking about when he brought Berkshire, how they went from in 9 years, $51 million to $22 million. And declining the company, how the company was declining and things like that, right? And how he turned everything around in 65 and kind of how he did it. So there's a great business lesson in there, because he always say one of his worst investments was Berkshire. So in fairness to our government partners, the government has acknowledged, indeed triumph, that Berkshire's prosperity has changed a falsely mildly because the company has operated in America. Our country would have been, so they're saying by being in America, they love being in America. So he said, when you see the flag, say thank you. So American flag, he's saying it has helped them out, and kind of his thing of going back saying thank you in the tough times. Now that they're prospering, they are a big asset to the U.S. Treasury. So from 8.6 million purchased a national indemnity in 1964, indemnity in 1967, Berkshire has become the world leader in insurance float. Here we go. Money we hold, so this float money we hold and can invest that does not belong to us. So I'm thinking this float money, I got to do some more research on this float money. I think it's money that they get from people paying premiums that they kind of got to put to the side just in case people file claims, if I'm not mistaken. But I'm not all the way clear on that one. But I'm getting, that's one of my lookups. So he said he got this float money. So he said, including a relatively small sum of derivatives from life insurance, Berkshire total float has grown from $19 million when we entered the insurance business to $147 billion. So this float money has gone from $19 million to $147 million. Then he said, this is money we hold and can invest, but does not belong to us. So it's kind of crazy. So far, this float has cost us less than nothing, though we have experienced a number of years when insurance losses combined with operational expenses exceeded premiums. Overall, we have earned a modest 55-year profit from the underwriting activities and generated our float. So when you look at the insurance business, everybody knows when the insurance business, every month, everybody that's listening to this auto playback pays insurance. You know, everybody got life insurance, home insurance, car insurance, health insurance, you know, whatever type of insurance. And how insurance companies make money is that everybody pays insurance, and the whole game is to make more money than you pay back. But he said in some years they end up paying more out than their premiums. And he said, I guess he's saying this is one of those years. But he said they have earned a modest 55-year profit for underwriting activities that generated our flow. So underwriting activities is the people when you go to get insurance, these are the people who qualify you for insurance, what your price is going to be, who they're going to insure, who they're not going to insure, right? When you're a high risk person or whatever. So, you know, shouts out to them. It's going to get further when we get into the four main arteries of Berkshire. So let's get into these four main. We're going to get into the big four. Let me see what y'all said in his comments. Mark says hundreds of billions in cash, I think. Pretty close. Can you narrow it down, Mark? He said they made a couple purchases this year, but I don't think they did a lot. No, they didn't do a lot. He kind of spoke about they didn't do a whole lot this year. So we're going to get into what their cash is latest. Hundreds of billions. I will give you that. It's you know, you're close, Mark. You know, you kind of how many hundreds of billions? So of equal importance, float is very sticky. Funds attributed to our insurance operations can come and go daily, but they aggravated the total is immune from the precise decline. When it comes to investing float, we can therefore think long term. If you're not already familiar with the concept of float, I refer you to a long explanation on pages A5. To my surprise, float has increased $9 billion last year, a buildup of value that is important to Berkshire owners, though it is not reflected on our GAAP, on their financial statement. GAAP is the generally accepted accounting principles, presentations of earning and net worth. So they got $9 billion in float money that's not put on their balance sheets, essentially. Much of our huge value creation is insurance. Right here, right? The big four, we're getting down to it. Much of our huge value creation is insurance attributed to Berkshire's good luck in my 1986 hire of Ajit Jean. We met on a Saturday morning. I quickly asked Ajit what is his insurance experience had been. He replied, none. I said, nobody is perfect, and hired him. That was my lucky day. Ajit actually was perfect choice and has been better. Couldn't even been better. He's been with him for 35 years, right? So now let's get into the big four. These are the big four things that keep Berkshire Hathaway alive and thriving amongst everybody else. Here's the big four things. How does Berkshire Hathaway make all of this money? A lot of people say, oh, stock picking, buying and selling stocks, businesses, whatever. Let's talk about it. It's pretty interesting. I actually wrote down a couple of notes with it too. Big four. Our four giants. Through Berkshire, our shareholders own many dozens of businesses. Some of these, in turn, have a collection of subsidiaries of their own. For example, Marmon has more than 100 individual business operations, ranging from leasing of railroad cars to manufacturing of medical supplies. Nevertheless, operation of our big four companies account for a very large chunk of Berkshire's value. Leading this list of cluster is our cluster of insurers. Insurance is number one giant. Berkshire effectively owns 100% of this group, whose mass float value we earlier described. So he's saying that insurance is their number one business, the insurance business. People think it's stock buying and business buying, because when you own a bunch of insurance, everybody pays insurance. He takes the money, he turns around and invests it, buys other things, buys stocks, other businesses, right? The invested assets of this insurers are further enlarged by the extraordinary amount of capital we invest to back up their promises. The insurance business is made to order for Berkshire. The product one. Here we go. This is the cool thing he said about insurance. Put in your thinking cap. About insurance, he said it's made to order for Berkshire. The product would never be obsolete. It would never be obsolete. Sales volume would generally increase alongside with both economical growth and inflation. I'm going to say that again. The product would never be obsolete, and sales volume would generally increase along with both economical growth and inflation. Insurance is very important. I'm not very important, but it's very boring. Who wants to grow up and be an insurance agent? Who wants to sell insurance? But the thing he said is that, hey, as the economy grows, insurance business grows. As inflation goes higher, so does it moves with inflation. And it's a product that will never be obsolete. There's all types of insurances out there. Business insurance. You can get insurance on your dog, insurance on your pets, insurance for this, insurance on your money in the bank, FDIC, all type of stuff. Now, here's another thing here. Here's another 2 nuggets. Y'all hit that thumbs up button as y'all coming in too. Here's another 2 nuggets that he put in here as well, that I thought was always good. Always, integrity and capital will forever be important. Our company will behave well. Integrity and capital. That's something I institute into my business of anything else. Having integrity and capital are very important, right? Something I write down and say, okay, that's a pretty big nugget. Now let's go back to it. Number 1, he already said it's an insurance business. It's number 1, right? What do y'all think number 2 is? Number 2 is Apple. Our runner-up giant, as measured by its year-end market value, is different sort of holding. Here, our ownership is a mere 5.5%, up from 5.39% a year earlier. That increase sounds like it's small potatoes, but consider that each 0.1% of Apple's earnings in 2021 earnings amounted to $100 million. 0.1% of Apple's 2021 earnings amounted to $100 million. We spent no Berkshire funds to gain this assertion. Apple repurchasing did the job. Apple repurchased its own stock. So they own 5.5% of Apple, and every 0.1%, they earn $100 million. That's crazy. It's important to understand that only dividends from Apple are counted in the GAAP earnings Berkshire reports. And last year, Apple paid us $785 million of those. So last year alone, they made $785 million just off of Apple dividends. All of the earnings, those hundreds of millions of dollars in value that they went up in Apple, that does not go into the balance sheet. The only thing they made was dividends from Apple, $785 million they made from Apple. Yet our share of Apple's earnings amounted to a staggering $5.6 billion. Their earnings amounted to a $5.6 billion. Much of what the company retained was used to repurchase Apple shares, an act we applaud. Tim Cook, Apple's CEO, Apple's brilliant CEO, quite merely regards users of Apple products as the first love, but all of his other benefits from Tim are manageable touch as well. Benefits of his manageable touch. So anyway, so in dividends alone, Berkshire, they're 5.5% of holding Apple. That dividend yield is $785 million. And they're saying, hey, just from their earnings alone, by owning 5.5% of the company, we all know that Apple is about like a $2 trillion company now. That's $5.6 billion for them in the value of Apple going up. Not too bad. So that was number 2, Apple. That's crazy, right? And he's saying when the stock goes up in value, that's not what he's getting. That's not what the company's making his money. They only count the dividends. The only thing that's going on the financial reports. Pretty cool, right? Let's keep going. Number 3. Number 3 is the railroads. BNSF, our third giant, continues to be the number 1 artery of America e-commerce, or not e-commerce, but America commerce. We got to move things across the world, which makes it an indispensable asset for America as well as Berkshire. If the many essential products BNSF carries were instantly halted by truck, which instantly hauled by truck, American carbon emission will soar. So it's saying that all the stuff that we carry on the railroad, if we put it up to our competitor, which is the truck, America's carbon emission will soar. Your railroad record earnings of $6 billion. It made $6 billion from the railroads last year in 2021. Here, it should be noted, we are talking about the old-fashioned sort of earnings that we favor. A figure calculated, now this figure is calculated after interest, taxes, depreciation, amortization, and all other compensations. So he's saying we made $6 billion after everything. We took home $6 billion. Our definition suggests a warning. Now, this is when he took a shot at corporate earnings. Our definition suggests a warning. Deceptive adjustments to earnings to use a polite description have become both a frequent and more factual as stocks have been rising. Speaking less politely, I would say that bull markets breed a I can't even say that word, bull. So a stronger bull. So right here, Buffett is calling out corporate earnings. He is saying that people or companies are reporting earnings, adjusted earnings. They're not telling you, hey, they're saying, oh, excuse me. Companies are saying they earn money, but they're being deceptive in making such adjustments. They're not taking out taxes. They're not telling you all of the things. So he's kind of giving a hint out there that people are being a little deceptive adjustments to overstate their earnings. And he's saying it's bred by this bull market that people are trying to keep up with earnings and say things that are not really true. All right. So he says BNSF trains traveled 143 million miles. So the railroads. Number 3 is the railroads. Number 4, something I didn't really know Berkshire for, but their number 4 thing. Let me see what y'all say in the comments before I go any further. Adam says VN.RNT. I don't know what that is, Adam, but thank you for tuning in. Braless Occasion. He said, where can I get this article? Okay. Let me show you guys and girls, you can get this article. It's not an article, but it's a PDF letter, whatever you want to call it, blog, whatever. You go to www.berkshirehathaway.com, right? I'm going to show it to you guys and girls right here live. Where do you get this article from? Where do you get Buffett's annual letter? You know what page are we on? We're on page 6, right? It's only 11 pages. So right here, you go to Berkshire Hathaway. Hold on. Is it showing my screen? There we go. You go to BerkshireHathaway.com. BerkshireHathaway.com. This is his website. Look at his website. It's nothing much that he puts up here, right? And you go down here, it says Warren Buffett letters to shareholders. Warren Buffett letters to Berkshire shareholders. You click on it. And he puts out one every year. And this one goes all the way back to 1977 to current day. So you can read old ones when inflation was super high. That's how I was able to read that one. So you go to 2021 because he's talking about last year. And then that's how I got to this letter I'm showing you guys and girls. So you don't have to worry about saying, like I always tell y'all, you don't have to go in to work tomorrow, tell your friends and family, hey, it was this goofy guy on YouTube or podcast or wherever you may catch him on Instagram that said this. You can say, no, he showed it to us. So that number 4 artery, number 1 was insurance. Number 2 was Apple. Number 3 was the railroads. Number 4 is Berkshire Hathaway Energy. Our final giant earned a record $4 billion in 2021. We know that energy is one of the largest inflated things right now. It has the most inflation 2021. That's up more than 30-fold from 122 million earned in 2000, the year that Berkshire first purchased a BHE stake. Now Berkshire owns 91.1% of the company. BHE record, I think that's Berkshire Hathaway's Energy, right? Hopefully I'm not being a fool saying it the wrong way. BHE record of accomplishments is as remarkable as its financial performance. The company had no wind or solar generation in 2000. It was then regarded simply as a relatively new minor participant in the huge electric utility industry. Subsequently, under Dave and Greg Abe's leadership, and Greg Abe is the guy who's looking at replacing Buffett. They're saying if something wants to happen to them, it's going to be Greg Abe that's going to take over. BHE has become a utility powerhouse and a leading force in wind, solar, and transmissions throughout the United States. Greg's report on these accomplishments appear in pages A3 and A4. The profile you will find here does not in any way, there is not in any way one of those currently fashionable greenwashing stories. BHE has been faithfully detailing its plans and performance in renewables and transmissions ever since 2007. To further review this information, visit BHE website at burkenergy.com. There you will see the company has long been making climate conscious moves that soak up all of its earnings. So I guess all of its earnings go back into making the company better. More opportunities lie ahead. BHE has the management, experience, capital, and the appetite for a huge power projection that our country needs. So there it is. So he's saying last year they made $4 billion in their energy sector, but they put all the money back into the future. So now this is what everybody knows Buffett for, stocks. Let's get to it. So Bras Occasion, I think she's saying okay. But yeah, you go to BerkshireHathaway.com. So let's get into it. Now we talked about his big four. Now let's get into the stocks. The list is not that long, and he's going to say something that's pretty profound about what's going on in the market today. Stocks on hand. So investments. Now let's talk about the companies we don't control. A list that again references Apple. Below, we list our 15 largest equity holdings. So they're only putting their 15 largest equity holders, not all their stocks. Several of which we can find the rest of them on the 13F if you really want to look at all of them. Several of which are selections of Berkshire 2 long-term investment managers, Todd Combs and Ted. Todd and Ted is the long-time people that control their equity holdings. Todd and Ted working. I think Todd is the CEO of Geico now, or I think it's Todd Combs is pretty cool guys. I met them before some years ago. So shouts out to Todd and Ted for doing their thing. At year end, their value part has total authority in respect to $34 billion of investments. So they control $34 billion of investments, many of which we do not meet the threshold value. We use the table below. Also, a significant portion of dollars that Todd and Ted manage are lodged in various pensions plans of Berkshire-owned businesses, with the assets of these plans not included in the table. So the number one company that they have 151 million shares is American Express. They paid $1.2 billion for them, and today they're worth $24 billion. Number two, Apple. They paid $31 million for them. It's the cost column, and they today it's worth $161 million. So they own 19.9%, almost 20% of American Express. They own 5% of Apple, right? And then Bank of America, they own 4.6 million of Apple, right? They paid 4.6 million in Apple, and today it's worth 45 billion. They own 12.9% of the company. The next one is the Bank of New York Mellon Company. They own 8.3% of the company, which it cost them 2.9 million. Now they're up to 3.8 billion. They got BYD, they got Chartered Communications, Chevron Corporation, right? They own 2% of Chevron. They own 9.2% of Coca-Cola that they spent 1.2 million on, and now it's worth 23 million. General Motors, they own 3.6% of General Motors. I never heard of this company, the Itachi Corporation, right? They own 5.6%. They own Mitsubishi, 5.5% of Mitsubishi. Mitsubishi and Company, Ltd., they own 5.7%. Moody's Corporation, which is, I think all they do is grade companies. They paid $248 million for them, and it's worth $9.6 billion. So Moody Corporations, they own 13% of the company now. I didn't know Moody Corporation was doing that good. I read it in one of his letters because he was saying that the overhead was so low for the Moody's Corporation. That's what I saw. He owned Verizon, 3.8% of Verizon, and U.S. Bancorp. I'm not a big fan of Verizon, but hey, good, right? So he said total equity investments carried at market is $104 billion. It's the cost. Now they have $350 billion, right? $350 billion in equities and stocks and stuff like that. So they got stocks. They own the railroads. Well, through BNSF, they own the railroads. They own insurance, Apple, and what was the other company? Energy, right? And they got $350 billion in total stocks. Not too bad. And those are the top 15 companies that they own in stock-wise, right? Then he talks about treasury bills. Here you go, right here. This is what y'all are looking for. When we said the cash on hand, how much cash on hand did Buffett say? Y'all ready for this? I wish I recorded in my studio when I had my mixer. So here we go. Berkshire balance sheets includes $144 billion of cash and cash equivalents. Of this sum, $120 billion is held in U.S. Treasury bills, all maturing in less than a year. That stake leaves Berkshire financing about 0.5% to 1% of the publicly held national debt. So right here, they have $144 billion in cash. I know who was kind of guessing earlier. They said it was a couple $100 billion in cash. So I was guessing earlier. I think it was Mark. So Mark said that he thought it was hundreds of billions in cash. I think it's $144 billion in cash that they keep $120 billion of it in treasuries. I don't know what they keep the rest of it at. Maybe in their basement. I don't know. Who knows? But there you go, $144 billion in cash. Can y'all imagine that? Cash on hand, juggernaut of a company bigger than a lot of banks. So here it is. Charlie and I have pledged that Berkshire will always hold more than $30 billion of cash and equivalents. We want our company to be financially impregnable, and never depend on the kindness of strangers or even that of friends. Both of us like to sleep soundly, and we want our creditors, insurance claimants, and you to do so as well. $144 billion in cash. Look at that. That imposing sum, I assure you, is not some patriotic way, nor Charlie and I have lost over preferences of business. So he's saying, why do we carry so much in cash? He said, why $144 billion? He said, indeed, I first manifested by enthusiasm 80 years ago on March 11, 1942, when I purchased 3 shares of City Services preferred stock. So he's saying back in 1942, he purchased shares of City Services preferred stock for $114.75. I did the math. He was 12 years old. I think he was born in 1930. He was 12 years old when he purchased. He purchased stock for $114 in 1942. With $114 adjusted for inflation, it's about like $1,980 something dollars. So he's a 12-year-old with equivalent of $2,000 today buying stock. And it's back in 1942. This is like World War II. He had access to buy stocks. Can you imagine that? He was buying stocks in 1942, back right around World War II, Pearl Harbor. He was buying stocks with about $2,000 in today's money. And he said it required all of his savings. He said that was all of his savings. The Dow Jones Industrial Average that that day closed at 99. The Dow Jones was 99. It was double digits back in 1942 when he was buying stocks. Now look at the Dow Jones today. My God. A fact that should scream to you, never bet against America. That's the message he puts out. Never bet against America. 1942, when he was buying stocks, the Dow Jones wasn't even in triple digits. 99. Now the Dow Jones, I think, is at, let's look it up. I think it's like 30-some thousand now. Look at it. 34,000 today. The Dow Jones is at 34,000 today, right? That is crazy. Brawler's Occasion said he wants everybody to get money. Yes, you know, that's why I look up and read his annual letter. He puts out one letter a year, and I go through and I read this, right? And look at this. You know, with his cash, he could make every American, because I think it's only like 300 something million American. He can make every American with his cash alone millions of dollars. We could all be millionaires, multi-millionaires with his cash alone without even touching anything else. Y'all hit the thumbs up button, right? Hit the thumbs up button if you're catching in and you like the content. So he's saying never bet against America. Never bet against America. Let me put this in here because I want to do a little segment on this. Here we go. Give me 1 second. Never bet against America. America. Oh goodness. Make sure I got this in. Here we go. Never bet. Yeah, what the? Make sure I type this in right. Okay. There we go. So right here. So why does Buffett say never bet against America? If you stroll up here, he would tell you. He said 80 years ago, on March 11, 1942, he purchased his first 3 shares of City Services preferred stock. That cost was $114.75, and it required all of his savings. In today's economy, when I looked it up, it was about a little bit under $2,000 in today's economy. And he said the Dow Jones Industrial Average that day closed at 99. A fact that should scream to you, never bet against America. He was saying when he was 12 years old, buying preferred stocks, the Dow Jones was at 99. It closed that day. And he's saying today, the Dow Jones is at 34,000. So in the last, 80 years, you've seen the Dow Jones just quadruple. That's why he says never bet against it. And this was at like almost a wartime. He said, after my initial plunge, I've always kept at least, people always ask me, Prince, how much stock should I buy? How much stock should I buy? I'm going to put that in here too. I mean, people always tell me, take your age and take 100, subtract your age, and what you're left over with, that's what you should buy in stocks, right? Should I own, right? So let's take what does Buffett do? You know, how we say, what would Jesus do? What would God do? Now we're saying, what will Buffett do in finances, right? He's saying right here, after my initial plunge, I've always kept at least 80% of my net worth in equities. My favorite status throughout this period was 100%. Wow. He said, my favorite status throughout this period was 100% and still is. Berkshire's currently 80% or so portions in business is a consequence of my failure to find entire companies or small portions that is a marketable stock, which meets our criteria of long-term holding. So he's saying that, hey, I want to do 100%, but he always kept 80% of his network in stocks. And he said the reason why he's only doing, he's so low right now, he said he has a failure to find entire companies or small portions that are stocks which met his criteria for long-term holdings. So right now he's saying in the market, he hasn't found anything that he's sitting on so much cash because he haven't found anything that he wanted to buy. He said, Charlie and I have endured similar cash-heavy positions from time to time in the past. These periods are never pleasant. He don't like doing it. They are also never permanent. And fortunately, we have had a mildly attractive alternative during the 2020-2021 by deploying capital. Read on. So the first thing he did was repurchase shares. Now he's going to get down here. Here it is. He's going to speak about the 3 ways to increase investors' value. 3 ways, Borrows Occasion said, so what's his criteria for buying stocks? Number 1, earlier in the show, he said durable economical advantages, companies that have a pure durable economical advantage. And number 2 was a fine CEO in a company that has long-term, that he's going to invest in for a long-term economical durable advantage with a first-class CEO. Those are the 2 nuggets that he gave out earlier when he talked about buying stocks or buying companies in general. So here it is, the 3 ways. He said there are 3 ways that we can increase the value of your investments. The first, always front and center in our minds, increase the long-term earning powers of Berkshire's controlled businesses through internal growth or by making acquisitions. So he's saying that, hey, increasing the earning powers of Berkshire is the number 1 way to earn money. He said today, internal opportunities deliver far better returns than acquisitions. So he's saying buying their own stock essentially gives them better return than new acquisitions. The size of these opportunities, however, is small compared to Berkshire's resources because they can do a lot pretty much. So number 1 way is to increase the earning powers through internal growth, right? Making a company earn more money or buying another company. And he's saying today, internal growth is far better than going out, acquiring a new company, buying a new company. That's the number 1 way. Number 2, our second choice is to buy non-controlling part interests in the many good or great businesses that are publicly traded, aka buying stocks. Number 2 choice is buying stock. From time to time, such possibilities are both numerous and blatantly attractive, right? Today, though, we find little that excites us. So he's saying buying stocks don't excite them as much. That's largely because of the truism. Long-term interest rates that are low. Oh, here it is, right? I forgot about this nugget. Long-term interest rates that are low push the prices of all productive investment upwards, whether those are stocks, apartments, farms, oil wells, or whatever. Other factors influence valuations as well, but interest rates will always be important. Everybody is saying inflation. This is why things are pushed up, blah, blah, blah. He's saying because of the low interest rates, everything is jumped up. Housing market is crazy. Everybody is making so much, housing market is crazy. Stocks are up. This is up. Everybody's up because of the low interest rates pushes everything up. And his idea is we don't want to buy wonderful businesses for a great, awesome price. They don't want to overpay. So right now, essentially what he's saying is low interest rates are making everything overvalued. That's why they haven't acquired anything. That's why they're sitting on 144 billion. Number 3, our final path to evaluation creation is to repurchase Berkshire shares. Throughout the simple fact, we increase your share of many controlled and non-controlled businesses through Berkshire ownership. When the price evaluation equation is right, this path is the easiest and the most certain way for us to increase your wealth. Alongside the assertion of value of continuing shareholders, a couple others parties gain. Repurchasing are mostly beneficial to the seller of the repurchased shares and society too. So he said repurchasing stocks, buying stocks, repurchasing their own shares, buying stocks, and also increasing the purchasing power of Berkshire are the three ways they increase Berkshire shareholders' value, right? So let's get it right here. Now that he said that, let's stroll on down. Let's see what else is in here. What other nuggets I got? Periodically, alternative paths of unattractive reimbursements. Good to see Berkshire owners. During the past 2 years, we therefore repurchased. They're telling me they're repurchasing their own stocks. There we go. Buyback opportunities, right? So here it is. This is a story that he told called A Wonderful Man in a Wonderful Business. It's about a guy named Paul Andrews who died last year. He went to his funeral. He is the CEO and founder of TTI, a Dallas Fort Worth company. Essentially, he says Paul, he was a purchasing agent for General Dynamics, and the company fell through the roof and fired everybody. He lost his job. He took $500 of his own savings and started TTI, which is the Tex Talks or whatever it is, renamed the TTI. And he said the company set itself up to distribute small electronic components. And first year sales totaled $112,000. Today, TTI markets more than 1 million different items with an annual volume of $7.7 billion. Why is this important? He said back in 2006, Paul was 63 years old. He found himself, he was a happy guy. He had his family, he had a job, he loved his associates, but he had one nagging worry. It was heightened because he recently witnessed a friend's early death that kind of left his family and business in dismay. Almost kind of like the owner of the Broncos. That's why the Broncos are for sale. What Paul asked himself in 2006 would happen to many people depending on him. He said, man, what would happen to all the people that's depending on me if I was to die? For a year, Paul wrestled with this option. He thought about selling to a competitor. From a strictly economical viewpoint, that course made more sense. After all, competitors would envision a lucrative synergies, right? But he said, but such a purchaser would most certainly also retain its CFOs, its legal consultants, HR. The TTI counterparts would therefore be sent packing. So he said if he sold to a competitor, he would, they would pretty much fire everybody. And he was trying to look out for everybody else. If a new distribution center was needed, the acquired home city would certainly be favored over Fort Worth. So he said, hey, that the distribution center, they would leave Dallas. This company would leave Dallas, fire all of his people. He didn't want to do that. So whether the financial benefits, Paul quickly concluded selling to a competitor was not his thing. His next thing was a financial buyer, right? So long story short, he pretty much he met with Buffett. He explained why he eliminated those two alternatives to buy. He then summed up a dilemma by saying, in far more tactful phase than this, after a year of pondering the alternatives, I want to sell to Berkshire because you're the only guys left. He wanted to sell his company to Berkshire, making billions of dollars. He started with $500 and he wanted to sell his company to Berkshire. He said he made Paul an offer. Paul said yes. One meeting, one lunch, one deal. He said he met with Paul with one meeting, one lunch, and one deal, and he brought TTI. He said to say we both live happily ever after is an understatement. When Berkshire purchased TTI, the company employed 2,387. Now that number is 8,043. A large percentage of the growth took place in Fort Worth, so he got to increase his own people. His earnings increased by 673%. He said annually he will call Paul and tell him his salary should be substantially increased. Annually, he would tell Buffett, we can talk about that next year, Warren. I'm too busy now. He said when Gabe L., the guy who's replacing Buffett, Gabe L. and I attended Paul's memorial. We met children, grandchildren, longtime associates, and they say he was a great guy. So they own that company now, and he kind of just spoke about being lucky. He said good luck. He got very lucky, and he kind of told the story of how he met with the new CEO, and consequently, they ended up meeting with the CEO of the railroad. Great story there. So shout out to Paul Andrews, right? And that's pretty much going to be the end of the letter, right? So there you have it, ladies and gentlemen. Hope y'all got something out of it. Great business, great, a lot of good nuggets out of it. That I was able to pull away from it. Maybe you got something different out of it. But looking at how much money, looking at Berkshire when you compare it to the S&P 500, it's crazy how well they have done over the years. So very, very good read. A read I do every year. I take notes every year. I sit right here in my office. I'm not in my studio today. I decided to kind of record into my office. I look a little dark in here because the light is not really lit in here. But hey, it is what it is. I wasn't focused on what you guys can see about me. I was hoping you guys and girls can get the content. Hopefully y'all got something out of this. Y'all hit that thumbs up button, share this, and grab my book series, Wesley Learns. Wesley Learns to Invest, Wesley Learns about credit, and Wesley Learns about insurance. Introduce your kids to investing, credit, and insurance at a young age. You can grab those anywhere books are available, from Amazon to BarnesandNoble.com, all of the good stuff. They're available hardcover at WesleyLearnsToInvest.com. But the paperbacks are available everywhere, even the audio. And check out this podcast. Follow us on Instagram, Facebook, YouTube. Wherever you can catch us. The podcast is on iHeart, Spotify, wherever you can catch podcasts too. Hopefully y'all got something out of it. Hope y'all liked it. But there we go. 2021, 2022, Warren Buffett's annual letter entail. He didn't really speak about the economy too much. I'll see what he says at his annual shareholders meeting. He didn't speak about the economy too much, but we'll see. All right. Well, ladies and gentlemen, until the next video podcast, cartoon, or whatever else crazy y'all see me doing around the globe, y'all know what my name is, Prince Dykes. I'm the Prince of Investing. Peace, be safe. I'm out, and thank you.